everyone. I'm Megan Trask, Director of our Investment Committee here at CTWM. I'm joined by my colleague and I guess Assistant Director. He's really a co-director. I don't know if he wants that title, but he deserves it, John Shanley. It's been a couple of months since you heard from us in this format, so we've got a lot to cover today. We thought we'd start with a review of 2022. And then, in the ever-changing, fast-paced world that we live in, dive right into 2023, current market conditions, and what we're seeing for outlook. So with that, John, I think at this point we all know how markets performed in 2022, and I'm sure in some ways we're all looking to get past that. But perhaps today you could shed a little bit of light on, how did CTWM's philosophies and decisions fare in the context of 2022?
Yeah, absolutely. I think you're exactly right. We've covered a lot of what happened last year. And to just give a really quick snapshot, we're going to share a visual here, which we find quite interesting. Megan and I were actually at a dinner last night, and the gentleman that was speaking shared this visual, which talks about the year in 2022 and how unique it was in this. He called it the Three Bears. And I don't think there was a Goldilocks involved anywhere. So Unfortunately not. So when we think about kind of the main asset classes that you invest in, stocks, bonds, and cash, all of those asset classes were negative last year. Cash was negative in the sense that after inflation. And the chart that you're going to see will show you on a historical basis how often those are down at the same exact time. And what was unique about last year, Megan, was that they were down together. So you couldn't really hide, right? And we talked about this throughout 2022. But as we wrapped up the year, that truth held for the entire year. Now, with that, there's not just one stock market, not just one bond market. In our portfolios, we do make adjustments to different areas and styles. And there were parts of our portfolio that held up better than others. For instance, an area that was attractive on a relative basis was small caps. And it's funny because markets are, as you say, fast changing and dynamic. When we went back just a handful of years, the best place to be was in large cap companies.
Right.
That was the story. And that happened for quite a few years. We maintained throughout those years our conviction in small caps because they do provide long-term benefits.
And knowing cycles change, leaders and laggers in each market cycle is different.
You've got it. And that's the beauty and the challenging of investing, right? Last year's winners tends to be next year's losers. So in terms of what worked last year, that small cap allocation really started to provide benefits. But what was also unique last year is that things changed throughout the year. So for instance, international markets, right, developed international companies in Europe and Japan, early on in the year, they did not help us. They detracted on a relative basis. But as the year went by, near the end of the year, we started to find some outperformance. So the story, like always, is a little bit muted. And we look at things on a year-to-year basis, but in reality, markets are evolving and changing day to day and month to month. So if we were to just take a quick step back, there were things that really helped us, like small caps and staying diversified. There were things that detracted on a small scale, like some of the fixed income moves. But now, as we head into 2023, some of those things are changing in the right direction. On that note, Megan, as we look into 2023, and we're sitting here in February, let's think about what's ahead.
Yes. So, John referenced we were at a investor dinner last night, and the chief strategist from Charles Schwab was sharing views on the market. So we're fresh off a really interesting topic. And I think probably what's top of mind for most folks as we think about economic issues that it could impact markets in 2023, recession, debt ceiling negotiations. So those are two topics that come up in meetings. They're certainly in the headline. They're certainly what analysts are covering. So if we start with recession, pretty much every traditional data point that we look at that gives us some clues as to where the economy is heading is screaming recession is coming. Whether you look at yield curve inversions or the leading economic indicators. However, what's potentially different about this recession is, what might make it harder to sort of describe and name, is that it seems to be happening not in every single geographic region, not in every single sector, but a little bit sporadically. For instance, if you look at manufacturing data in the U.S., it looks pretty recessionary right now. You look at retail and inventory data, again, looks recessionary. Some countries in Europe are fledged in a recessionary environment. But you look at consumer spending, you look at the labor market in the U.S., you look at the service industry, just go to Disney or try to get a dinner reservation in the U.S., you don't see recession there. Again, you can look at other developed nations who have so far, again, managed to be staying out of recession. So I think it's making it harder for economists to say for sure, yes, we're in a recession. And that might just be the nature of this recession, that it lasts a little bit longer and it's not as deeper and it has, again, kind of sporadic impact to different aspects of the market.
Your point is such a good one too, Megan. Even if we think about the job market, an area that we looked at on the investment committee, a lot of the news articles today, you'll see a lot of these technology companies with layoffs, right? Every time you open the Wall Street Journal, there's some news of it. And that's true, right? There is a recession, you could probably say, in that area. People are losing jobs and companies are pulling back. But then when you take a step back and look at the broader job market, we have one of the tightest job markets in 50 years. Our unemployment rate is 3.4%, and we haven't seen that since 1969. So it's muddled, right? And
exactly.
We think of a recession on a global basis, but maybe it is more local, as you said.
Yeah. And potentially, or perhaps more importantly, and I know this sometimes feels counterintuitive, but this is something, a recession, of course, could have wide impacts on the economic environment, but it doesn't necessarily impact the decisions that we're making in the portfolio. And that all has to do with time frame. So even when we look at the worst recessions and the stock markets that have accompanied those recessions, the time frames are relatively short in most investors' time horizon. So again, it's a huge issue and something that we're following, but doesn't necessarily lead us to make changes in the portfolio.
I'll add this, is even on a shorter term basis, recessions tend to lag the stock market, or another way to put that is the stock market tends to fall about 9 to 12 months in advance of a recession. So even if we could say with certainty we're going to hit a recession sometime this year, that doesn't change our investment stance really at all.
Right, exactly. And I think likewise, the same could be said for the debt ceiling negotiations and issues that we're facing there. Again, this was a point that was made last night. The U.S. is one of the only countries that even has a debt ceiling. So in some ways, this number is a little bit arbitrary. These discussions are political and they're going to dominate headlines, and they absolutely may lead to some market moves, especially as we get into summer and these discussions ramp up. But in terms of impacts to the economy and the portfolio, over the long term, we can look to Japan as a good example of a country who's had a massive debt load for a very long time, bigger than ours compared to the size of our economy. A really tough demographic issue, meaning they have less options to get out of their debt predicament, and yet there's been really no catastrophic impact to their economy, at least yet, and directly related to the debt. So I think that gives all of us, again, some signs that we don't expect there to be wide impact here in the U.S. economy either, even though it's going to be a really highly politicized issue.
And even when we look back at U.S. history, we've lived through fiscal cliffs before and debt ceiling raises, and it tends to have a lot of political theater to it. And it doesn't mean there might not be some short-term volatility, but in the long term, it really doesn't have much of an impact on economic fundamentals and the ability to invest for the long term.
Yeah. So we just talked about two potential economic issues that are not impacting portfolio decisions. John, do you want to spend a little time on some trends that we are seeing that perhaps do have some impact to what we're thinking in the portfolio?
Absolutely. So these trends, we'll kind of break them down into almost timeframes. And I think what Megan alludes to and what we always try to maintain is perspective. Markets are ever evolving, and there might be interesting day to day, right? We love that data, but for the most part, none of that is actionable. It tends to be noise and not signal. Now, when we think about the kind of the opportunity set that is out there, there are interesting areas that we look at and that we continue to have a deep belief in. One of those areas is fixed income. And I know for years fixed income was boring, but not as much anymore. I guess it depends on who you talk to, but you'll see a chart here, which we call it the upside of downside. And what you're looking at is a snapshot of the interest that you could earn on certain instruments at the beginning of last year versus the beginning of at the end of 2022. So now, and what you'll notice is there has been a huge uptick in the yield that you can earn on various sectors within the bond market. I'll just give you one example, for instance. The yield that you can get on investment grade bonds, we can consider those kind of safer bonds in the broad sense.
And the kind of core position in most of your portfolios where you have bond allocation.
Exactly right. So at the end of 2021, you were earning 2.35% on those bonds. We sit here at the end of 2022, and that is 5.5%, right? So a doubling pretty much in your yield in just a very, very short period of time. And so I think probably the next question is, why does that matter? And the next chart you'll see, apologies if it's a little nuanced, but what it's showing you is the current yield of your bond means everything for the future, especially when we think about the safer types of bonds that we invest in.
Yeah.
So you're seeing on a historical basis, the starting yield, which is the blue line on the chart, and then your 10-year future return, which is the green line. And all that's really saying is that the yield that you're going to get when you buy your bond and your subsequent 10-year return, they're very closely aligned. So I say all that to say that, again, fixed income looks attractive because our yields are now quite attractive. And as long as we have the right time frame, right, which is not 6 months, it's not a year, it's 3, 5, 10 years for these types of instruments, it's a very attractive time period.
And that time frame is what allows us to position the portfolio appropriately. So this is, the bonds that we own mature over kind of 3 to 5 years, many of the bonds. And so that is enough time to position the portfolio appropriately to take advantage of these current rates. So it's a good example of a trend and a data point that, we have shifted the way we allocate to bonds and what types of bonds because of the interest rate environment.
You're exactly right. And this was, it seems like lifetimes ago, but it was in July of last year where we were able to take away some of the risk that we have with our bond funds in terms of the credit risk, right? The riskiness of the companies, because you can now buy these safer bonds and they're giving us exactly what we need for our financial plans to succeed.
Yeah.
The other area, and there's one last chart here I'll show everyone, is international stocks. And to go a little bit inside baseball, international stocks has been an area that the investment committee has talked about and debated for years. Mm-hmm. And we've always maintained a conviction in having an allocation to international stocks. It hasn't always been easy. As this chart is going to illustrate, there has been a really large divergence between the performance of US-based stocks and international stocks. For the last handful of years and really the last decade or so, it has been a US-centric story. International stocks have underperformed. But as we kind of learned last night in this interesting chart with the jaws closing, that looks to be changing a little bit, right? We are continuing to see some really interesting opportunities in the international space. And what's most important, I think, from our vantage point, these are not things on a short-term basis you can time. It really doesn't mean anything in the short term. But when you think about long-term cycles, this is where opportunity exists. And this is why we try to be patient and diligent in staying diversified throughout our sectors and various geography that we invest in.
Yeah, and when we see charts like this, so the orange is, when you see the orange line going up, it's the US outperforming. When you see the blue line going up, it's international stocks outperforming. And this is a great example of why it's so important to stay diversified. These are massive dispersions, right? And so as diversified investors, our hope, of course we want to be closer to the line that's going up, but we know we're going to be somewhere in the middle, and that's why we maintain allocations to both markets. And again, it's why diversification is key to a long-term investment strategy.
Exactly right. We always joke investing is very easy in hindsight, right? But when you try to look forward, one of the best ingredients to deal with uncertainty is staying diversified. We do believe there's opportunities in markets to move a little bit here or there, right? And make it underweight and overweight, but these last 3 years, if they've taught us anything in terms of the volatility with markets and the economy, is to stay diversified and to have a lot of humility in the face of what's an ever-changing landscape.
Yeah, to that point on volatility, in the last 7 or 8 months alone, the monthly market returns have been 5%, meaning 1 month the market is up 5%, the next month it's down 5%. You can get into a lot of trouble if you try to be too tactical in these short periods of time because of that volatility. So it really is, difficult to do that. And again, just more and more data to show and prove why that long-term mindset, staying diversified, is important. So we've talked about a couple of economic issues and market issues today. For those who want to dive deeper, we're really excited. We're going to have our friends from Fidelity back in early April, and we're going to dive deeper with them. So again, we hope you'll join us for that video. And in the meantime, we look forward to meeting with all of you and starting off a new year and digging into the evolving plans of all of our clients. So thank you.